Welcome to the Small Business Tax Savings Podcast, powered by Jetro. Each week, we bring extremely valuable accounting and tax tips specific to small business owners. You will be on your way to growing your business and putting more money in your pockets. Here's your host.
Hello, small business owners, and welcome back to another episode of the Small Business Tax Savings Podcast. I am your host, Mike Jesowshek, and today's topic is on what are bookkeeping, debits, credits, and the chart of accounts. Now, before we get into that, this episode is brought to you by Jetro, a digital accounting firm servicing small business owners across the country, helping them relieve stress around financials and save thousands in taxes. Again, today's topic is on what are bookkeeping, debits, credits, and the chart of accounts. So this is part 2 in our All About Bookkeeping series. If you missed the first one, check that one out. It's what is bookkeeping and why do I need bookkeeping for my business? And really the purpose of that first episode was to give us a solid foundation of what bookkeeping is. And now every week after, we're going to dig a little bit deeper, go into very specific things so you can have a full grasp and understanding of what is involved in bookkeeping. So today we're going to be talking about what are debits and credits and why do they matter and what is a chart of accounts. Now, when we look at debits and credits, many of you probably have a prior knowledge of this, usually associated with a bank account or a credit card, and we really need to kind of throw that out when we think of debits and credits when it comes to bookkeeping. So simply put, debit means left side and credit means right side. And so when I'm talking about left side or right side, I want to kind of go back to, if any of you have taken bookkeeping classes in college or anything like that, I want to go back to this idea of a T account. So basically, you take a piece of paper and write a big T on it. Now that T is going to represent an account. That account could be cash, that account could be office expenses, but every account is going to have a T. And on each side of the T, you're going to have a left side and a right side. Debits go on the left side and credits go on the right side. So let's say you have a cash account. You'd draw a T on a piece of paper. On the top of the T, you're just going to write cash. On the left side and the right side of the T, you're going to have debits and credits. And you can have a debit and a credit on various different accounts. Now, when we think of these T accounts and when we're talking about debits and credits, every transaction has both a debit and a credit. So you need, for every transaction that you code, you're going to need a minimum of 2 accounts, and at least one account is going to be debited and at least one account is going to be credited. For example, if you buy a package of paper clips using cash, you're going to debit expenses and credit your bank account or credit card account, whatever you might have used. Total debits must equal total credits. So if you have a debit, that means you have to have a credit to offset that. Now, when we're talking about these debits and credits, they affect accounts differently. So accounts that increase with debits. So if you debit this account, it's going to increase would be assets, expenses, and owner's draws. Consequently, these accounts decrease with credits. So an asset would be like cash. If you have a debit, that means cash is increasing. If you have a credit, that means cash is decreasing. Now there's these other accounts that increase with credits. These would be liabilities or loans or credit cards. This could be income or owner contributions. And again, consequently, these accounts will decrease with debits. So if you have a loan, a credit would increase that loan amount. A debit would decrease that loan amount. So that's kind of this idea behind debits and credits. Again, simply put, debit equals left side of the T account and credit equals right side of the T account. Now, when we look at chart of accounts, the chart of accounts is very important when you're doing your bookkeeping because this is what creates your financial statements. A chart of accounts is a listing of the account names that every transaction has the ability to be coded to. So it's accounts that are available for coding. So we talked last week that a bookkeeper will take the transaction types we discussed, whether that's spend money, receive money, things like that, and assign them to their respective accounts or categories. And these accounts or categories are found in the chart of accounts. The chart of accounts is every account or category that you can book a potential transaction to. So when we think of this chart of accounts, there's certain types of accounts that are on there. You have assets, liabilities, equity, income or revenue, and then expenses. So assets would be a bank account, office equipment, vehicles. Now, assets generally carry a debit balance, as we kind of discussed earlier. Liabilities would include credit cards, loan payables, a sales tax payable, a payroll tax payable, and liabilities generally carry a credit balance. So assets carry a debit balance generally, liabilities generally carry a credit balance. Then we have equity. This could be owner's contributions, owner's draw, current year profit or loss. And equity accounts can carry both a debit and credit balance depending on the type of the account. When we have income, this would be like sales income, product income, refunds. Income is generally a credit. Now I say generally because if you have sales, that's going to be a credit. But if you have refunds, that's going to be a debit, so kind of a contra to the income account. And then we have expenses. This could be bank service charges, office expenses, payroll tax expense, postage, rent, wages and salaries, etc. Generally, expenses are booked as debits. So when we have these chart of accounts, we're going to have all these different accounts that we can book things to. Bank accounts, the office equipment, which are all assets. You're going to have liabilities, which would be a credit card or a loan. You're going to have equity, which is you put money into the business, you taking money out of the business, your business performance year over year. You're going to have income and expenses, different things that you can book your potential income to, different expense categories to book money to, or to book items to when you spend money. And these are all in the chart of accounts. No company likely will have the same chart of accounts. Every company will have a different chart of accounts. Usually different industries have different chart of accounts. So an accounting firm, we might have a big chart of accounts for software, if we're using cloud-based software, things like that. Whereas an electrician, they might not have much for software expenses. They're going to have a big chart of accounts or a bigger emphasis on small tools, small equipment, contract labor, things like that. And so when we think of this chart of accounts, and when we think about when we're booking and coding transactions using debits and credits, we want to think about the accounting equation. Basically, the accounting equation states that assets equals liabilities plus equity. So every transaction must have both a credit and a debit that will balance that equation. So if you increase your assets, that means that you're increasing something in the liabilities or equity side. Because again, assets must equal liabilities plus equity. If you're decreasing assets, that means you're decreasing something on the other side to equalize it out. So to help better understand debits versus credits in the chart of accounts, let's go through a few examples. Let's just say you receive income for services. You deposited a check for income that you received. In this case, you would debit cash. So you're increasing cash, and you're going to credit revenue, which is increasing revenue. And so if we look at the accounting equation, we have a cash as an asset and revenue as part of the equity section, which balances the equation. We have both a debit to cash and a credit to revenue, which means we have a debit and a credit that balance out. Now let's look at paying rent. You write a check to pay rent. You're going to credit cash, which decreases cash, and you're going to debit rent expense, which increases rent expense. Now, let's say you transfer money from the business account to your personal account. This would be an example of an owner's draw. You would credit cash, which basically means you decrease cash, and you're going to debit owner's draw, which increases the owner's draw account. Again, every transaction that you do will have both a debit and a credit. Now, you'll notice sometimes when you're working in accounting software that you're not entering two accounts. And that's because the accounting software knows if you're booking a transaction that is running through the bank account, the software already knows that we're debiting or crediting the bank account. And so all you need to do is pick the other side of that equation, and it's going to do the debits and the credits for you. But as you can kind of see with these examples, everyone has an account that is debited and also an account that is credited for the same transaction. Again, every transaction must have both a debit and a credit, at least one, and they have to balance out. Your debits must equal your credits. And then you'll also notice the accounting equation balances for each one. Assets equals liabilities and equity. So you can have something that doesn't affect assets, but then that would mean it would increase liabilities and decrease equity or something where it would balance out there. So this article was meant to kind of give you a deeper look into what bookkeeping is, what is going on in the background. I wanted to do this to kind of lead up to what we're talking about next. Cash versus accrual accounting, income statement versus a balance sheet, income and expenses, what is balance sheet? And this is kind of just an introduction into that. So I know that some of this might seem complex, might seem a little deep. I don't want to go in here and teach you guys, do a full accounting class with this. I just want to give you some very high-level review of some of these items, because it's going to help make some of the things down the road that we discuss in the next episodes, it's going to help them make a little bit more sense. So again, this is just the start of our series. Be sure to check back for future episodes that we do, and be sure if you missed our last one to check that one out first. As a summary to what we discussed today is debits basically just mean left side of the T account, and credits mean right side of the T account. And every transaction has both a debit and a credit. Total debits must equal total credits. Accounts that increase with debits, they go up, would be assets, like a cash account. You debit a cash account, your cash account goes up. Expenses increase with debits. You debit an expense account, your expenses go up. Owner's draw increases with debits, and then consequently, assets, expenses, and owner draws would decrease with a credit. Amounts that increase with credits would be liabilities and loans, income, owner's contributions, and then consequently, those accounts would decrease with debits. So they increase with credits, decrease with debits. And a chart of accounts is, again, just a listing of the account types that you can categorize a transaction to. The chart of accounts is broken down into different categories: assets, liabilities, equity, various income items, and expense items. So everyone's going to have a different chart of accounts. When you're booking transactions, you have a transaction, a spend money transaction to, you have to have an account that you book it to, and that is found on the chart of accounts. So that could be bank charges, office expenses, wages and salaries, rent, whatever it might be. And we always want to remember the accounting equation. Assets equals liabilities plus equity. So again, that's what we're talking about today. We're going to dig deeper into this. We're going to talk about, now that we have this base foundation, what is bookkeeping? We talked a little bit about in the weeds of debits, credits, chart of accounts. What is a chart of accounts? Now we're going to dive deeper into the financial statements and really kind of get into the good stuff that helps you when you're analyzing your bookkeeping and doing your own bookkeeping, or have an accountant doing your bookkeeping for you. It's going to help you better understand the information they're sending you. So as we continue this series, if you have questions on it, be sure to post them in our Facebook group, shoot me an email. And we also have an article to our blog post on this specific topic on our website, which I'll put in the show notes as well. Thanks again for listening to another episode, and I will see you guys next week. Now, one last thing before I go. Don't forget to check out our podcast website at www.jetrotax.com. Simply click resources and then podcast, where you can go there and check out our past episodes. Also, don't forget to join our free bookkeeping training program and free Facebook group. I've provided links to both of these in the show notes below.
This has been another episode of the Small Business Tax Savings Podcast from the team at Jetro. If you enjoy our weekly episodes, please leave a review on whatever platform you listen to us on and share with other business owners. If you have any questions or future topics you want to hear, email them to tax@jetrotax.com. Thanks for listening and have a great day.